Hi, today I, Gautam Rath, I'm here to present on the topic of under and overcapitalization for my financial management CIA. So, what exactly is overcapitalization? I will go ahead and explain with the help of an example. Let's say you buy a house for $500,000 and then you add renovations to it for another $500,000, making the value of the asset to $1 million. But then you want to sell it. However, all the houses in that locality are at $700,000. In a case like this, your asset is overcapitalized. This doesn't mean you won't be able to sell it, but it just means that you will take a considerable longer time to get around selling it, or the value of the asset will reduce and you will end up making a loss on the deal. In the words of Gestenberg, a company is overcapitalized when its earnings are not large enough to yield a fair return on the amount of stock and bonds that have been issued, or when the amount of securities outstanding exceeds the current value of the assets, which simply means a situation when a company has issued more debt and equity than its net assets worth. They have a higher debt obligation in forms of interest payments and dividend. They might need to buy back and restructure their capital structure. In the insurance sector, when the supply is greater than demand, the insurance premiums decline and continue to do so till the price stabilizes. Overcapitalization is simply when the valuation of an asset is superior to its real value, leading to putting a strain over a possible return on investment. So, let's look at a table to help understand this better. There are two companies, Company A and Company B, in which both are getting a return of $500,000 on their investment. However, the investment in Company A is at $5 million and at Company B is $6 million. So, the rate of return of Company A is at 10%. However, for Company B, it's lesser than that and is at 8.34%. In this, Company A is adequately capitalized and Company B is overcapitalized. There can be several reasons for overcapitalization, like acquiring assets or like goodwill at a higher price, acquiring assets during a period of high inflation, or showing assets at a higher price due to unfair depreciation policy. Example of the third one can be Reliance Jio, which follows an unfair depreciation policy of charging their asset at only 2% of depreciation, whereas their counterparts in the telecommunication industry are charging their assets at an average of 9%. This had led to Reliance showing a greater amount of profit in reality where they should have shown a loss. So, this was all about overcapitalization. Now, the opposite of that is undercapitalization. Undercapitalization is simply a situation where a company has neither the cash flow nor the access to credit that it needs to finance its operation. It mostly happens in companies with high startup costs and high debt with little cash flows. It is a major factor for bankruptcies where companies find it difficult to find the sufficient capital to conduct normal business operations and to pay the creditors. It is mostly found in new businesses and also in large corporations who have taken up large sums of debt and are suffering from poor operational conditions. The reasons for undercapitalizations can be financing growth with short-term profit and not long-term capital, not getting funded at the right time, or adverse macroeconomic conditions like an economic downturn. But according to the Federal Deposit of Insurance Corporation, banks are classified according to the risk-based capital ratio, in which a well-capitalized company or bank has 10% or higher of this ratio. An adequate capitalized company has 8% or higher, undercapitalized has less than 8%, significantly undercapitalized has less than 6%, and critically undercapitalized has less than 2%. At the significant undercapitalized situation, the Federal Deposit Insurance Corporation can take over the management of the corporation, and when it hits the critically undercapitalized situation, the banks can be completely taken over by the government of the United States and the operations will be completely handed over to the federal or the state government. The classic example for undercapitalization was the 2008 mortgage crisis, where most investment banks and mortgage issuers like Bear Stearns, Lehman Brothers were undercapitalized, where they failed to ensure that they had enough capital or insurance to cover the risk or mortgage defaults in case of a bubble burst. This led to the global financial crisis of 2007-2008 because those banks which had taken on debt were simply not finding the cash flow to return the borrowings on the bond amounts. This was my video on over and under capitalization, and I hope you learned something new today. Thank you.